In the last set of videos, we made a simplifying assumption for walking through the accounting of the equity method. Namely, we assumed that the investor pays exactly book value for the investment. That's not always the case. In fact, that's rarely the case. Now, under the equity method, when the investor pays in excess of book value, pays more for the investment than the book value of the investment would suggest, when that happens, the investor always records the value of the investment at the original purchase price. That's even if the book value of the investment is lower, or less likely higher. Usually you're paying more than the book value of the investment, although that's not always the case. So to be specific about the balance sheet impact during the initial investment, using the equity method when the investor is paying more than the book value would suggest, what ends up happening is if the purchase price is higher than the investor's share of book value acquired, the excess is allocated to the specific affiliate assets that are undervalued on a book basis. So typically this ends up going to intangible assets, inventory, property, plant, and equipment. If no individual assets can have the excess allocated to them, in other words, if the excess of the purchase price over the book value of the investment isn't tied to the fact that any specific affiliate assets are undervalued, then the excess has to be allocated to goodwill. Notice that this occurs on the investor's internal working papers. You don't actually see this on the face of the income statement, on the face of the balance sheet. On the face of the consolidated balance sheet, the investor only shows the affiliate investment asset as one line item at the original purchase price, just like in the prior examples where we paid exactly book value. Now, what ends up happening that's interesting is what happens during subsequent periods. During subsequent periods on the income statement, the fact that now you have paid more than book value and that you've allocated that to individual assets of the affiliate, the fair market value write-ups of those individual assets are then reflected in an annual reduction to the investor's proportional share of the affiliate's reported net income in light of the higher depreciation and amortization expense associated with those assets that you've now written up. Goodwill, of course, is not amortized, but is tested annually for impairment. So the impact on the income statement, on the investor's income statement, of paying in excess of book value has to do with the write-ups and the depreciation and amortization associated with the write-ups of individual assets from the affiliate. The easiest way to make sense of this is to go through a simple example before we dive into our more complicated exercises. In our example, Google invests in Yahoo. Yahoo's book value is $16 billion, and let's say that Google acquires a 25% stake in Yahoo for $10 billion. Now, on a book value basis, a 25% stake would be $4 billion, but Google has spent $10 billion, and that represents a $6 billion excess over the book value of the acquired share. And that happens quite frequently. Companies often pay significantly above the book value of the assets the net assets that they're acquiring. The next stage, once we've recognized that Google has spent $10 billion for a company that has, for a stake that really justifies on a book value basis only $4 billion, the next question becomes, where does that $6 billion excess go? How is that allocated on Google's financial statements? So what ends up happening is on Google's internal working papers, $4 billion of that $6 billion excess, they determine is attributable to intangible assets. So this is just an example. Let's say they determined, using appraisals of intangible assets, that Yahoo's intangible assets are grossly undervalued. And that's what's justifying a lot of the undervaluation of the book value. It's justifying a lot of why Google is paying so much more. And so let's say that we determine that of the $6 billion in excess that we paid, $4 billion of that excess can be attributable to intangible assets undervalued on a book basis. And let's say those intangibles have an average useful life of 10 years. And let's say that we've determined that the remaining $2 billion of that $6 billion excess is unattributable to individual assets, and thus allocated to goodwill. That's what has to happen. If you can't allocate any excess of the purchase price to any individual assets, you have to allocate it to goodwill. And of course, goodwill isn't amortized, unlike the intangible assets in this example. Let's also note that Yahoo reports $2 billion in net income in 2016. So the year after this investment initially takes place, Yahoo reports $2 billion in net income. So what Google will recognize during the initial investment is the $10 billion purchase price. So you're going to have a $10 billion purchase price being recognized as the investment asset, right? Cash will go down by $10 billion, and an investment asset will go up by $10 billion. But in the next year, Google is going to recognize on the income statement not 25% of $2 billion, which is Yahoo's reported net income, the way we had done in prior exercises when the book value exactly equaled the purchase price. But what they're going to do is they're going to adjust that 25% times $2 billion or $400 million or $500 million down by the incremental amortization due to the write-up of intangible assets. So we have intangible assets worth $4 billion with a useful life of 10 years. That means every year that excess intangible asset fair value generates $400 million in intangible asset amortization. That doesn't actually affect the Yahoo financial statements. It doesn't affect what Yahoo's reporting for net income because they don't get to write up those intangible assets using the historical cost principle. But Google, as an equity investor, does recognize the write-up. So this is a little bit tricky. So Google will actually recognize not $500 million, which is the 25% share of the net income that's reported by Yahoo, but 500 minus 400 million in intangible asset and intangible amortization. So the net result is $100 million in affiliate income recognized.